Hi, and thank you for watching this video on how does a line of credit work with a reverse mortgage. So the first thing I want to do is make sure you understand that everything you see is for educational purposes only. Although the numbers are pretty accurate, I don't want anyone to come away assuming that they get a particular interest rate or this is exactly how much they'd get if their house was worth the same thing. Everybody's situation is different, everybody's age is different, credit profile is different. Now, that being said, I've done my very best to make a reasonable presentation with reasonable figures, but I need everyone to understand there are no guarantees until we have a credit pull and we've examined all your particular numbers, okay? So, enough of that, let's move forward. How does a line of credit work on a reverse mortgage? Well, lines of credit kind of work like a credit card, if you can imagine that. If you use the line of credit, then you'll increase the outstanding balance of the loan. Okay, it's really that simple. If you use it, just like a credit card, you now have an outstanding balance. Now, the difference is with a reverse mortgage, no payments are required on that outstanding balance. Right? With a credit card, you pay it, but with a reverse mortgage, you do not pay it. So then the question is, when do you pay it? Well, you always have to pay something, right? But reverse mortgages, the balances are due when the home is sold. So let that sink in for a second. Whatever you owe to the bank is paid when the home is sold. Okay? Between the time you get the reverse mortgage and when you sell the home, everything is accrued, not paid. Okay? So hopefully that's real crystal clear. Now, unlike your credit card, your unused line of credit will grow year over year. You'll see examples of this coming up shortly. Okay? Now, so let's take an example. I think people learn best by examples, so that's why I have a number of examples here. So let's say you have a home and the value is $300,000 and it's free and clear. The home does not need to be free and clear. It just has to have enough equity to do the reverse mortgage and potentially get a line of credit. But in our example, it's free and clear. So assume the bank will allow you to access, $140,000 of the $300,000 after closing costs. That number varies, okay, based on age, credit, and program you choose. But I want to give you something at least that's reasonable. Right? Now assume an interest rate of 4.5%. Now that's made up of your interest rate plus your annual mortgage insurance of 0.5%. So we're going to use 4.5%. That's compounded year over year on your line of credit. Okay, so that $140,000 is going to grow by 4.5% year over year. Okay? So on day one, you go to closing, your balance is $140. It's just that simple. That's what they're going to give you access to. So that's your balance. Now, they do give it to you over 366 days, a portion in year one and a portion in year two. But again, for purposes of this conversation and this education, you have a $140,000 line of credit. Okay? But after 1 year, assuming you didn't use that, you just had it there as a safety net in case you needed it, that line of credit would grow from 140 to a little over 146. Okay? It actually gets compounded monthly. I just did it annually as an example to make it simple. And of course, we just round numbers here for illustration purposes. Okay? So I want you to see how your line of credit can actually grow year over year based on the interest rate. And in this case, it grew about $6,300, which is a very big number. That could pay your taxes. That could pay taxes and homeowners insurance. That could pay maybe some medical costs. I don't know. So that's a big number that your line of credit grew by $6,300. So what happens when you actually draw on the line of credit versus just letting it grow? Well, it's real simple. So let's assume we took $10,000 out of the line of credit. It could be for anything you want or need. It could be $20,000. It's just, again, an example. So if you started with 146 and you took 10, well, now you have 136. We'll assume you did that the first day of the next year. Again, just for simplicity. So you have $136,000. Well, I just told you your line of credit will accrue interest, right? It's going to grow. I should say your line of credit will grow based on the interest that you have associated with your loan. So what is 136 going to look like after a year? Well, at the end of the year, your 136 will be about 142. Again, we're using the same 4.5%, just for simplicity. So as you can see, your line of credit started at 140 when we took it out at the day of closing. it went up to 146, but then you took 10,000 and went down to 136. Then, of course, it grew again, and now it's at 142. So you can get an idea that this can be really beneficial to you in your particular situation, right? And everybody's numbers will vary. So if you like this, give me a call and we'll work them out for you. Now, you would also increase your loan balance by $10,000. Now, I said it once and I'll say it again. If we take $10,000, that $10,000 increases your loan balance, okay? So let's look at the next slide. Assume you had a loan balance of $25,000. Again, I'm just picking a number out of the air. If you drew $10,000 in your line of credit or you used $10,000, well, you'd have a loan balance of $35,000, right? Pretty simple. When is it payable? When you sell the home, okay? Say that over and over because I want people to know when you have a reverse mortgage, there are no payments due other than your taxes, insurance, and any applicable HOAs you may have on your home, all right? If you have flood insurance, of course, you got to pay that. But there's no principal and interest payment, just to be precise. So let's assume that you owe $35,000 and you sold the house the next day. Again, just to make a point, selling it the next day, right? What would it look like? Well, the same $300,000 home hasn't appreciated. We'll say it's still $300,000. You subtract your loan balance of $35,000, and you would get a check at closing for $265,000 less normal selling costs. Well, what are those normal selling costs? Things like realtor's commission, titles, stock stamps, on the deed, they call them their transfer taxes, stuff like that. Okay, we're not going to get into that here, but just so you know, it's normal closing costs. Nothing special, nothing fancy, just right, whatever they are, they are. So then somebody might say, well, what happens if I don't use my line of credit? Well, this really gets exciting. Well, it continues to grow and grow and grow and grow. Okay. Now, some seniors take out a reverse mortgage as a safety net. They just, when they're 62 or 63, their financial planner tells them about it. They say, "Oh, this is really interesting," and they look into it and they go, "Oh, this could be a good safety net." So we'll see more of that in the next slide. So here's a simple example, right? So we talked about line of credit growth. How does it technically grow? Well, it technically grows based on your interest rate plus your mortgage insurance. We're using 4.5 because it's a reasonable number in today's world. Could be different next year, but could be higher, could be lower. We don't know. So how much will it grow? Again, it depends on the interest rate. And again, we're going to use 4.5% for simplicity. So what if you had a $136,000 line of credit? And what if you had an interest rate of 4.5%? That includes your mortgage insurance, okay? Well, after 5 years, that line of credit would be extended to approximately $169,000. After 10 years, it would be extended to about $211,000. This assumes you didn't use it. It just keeps growing, right? So now think about this. If you took out a line of credit when you were 62 years old, and now you're 72 years old or 73 years old, and you have over $200,000, $211,000, $215,000, whatever the number is, a big number, right? It's sitting there, and you can access that money for any want or any need, and you don't pay it back until the home is sold, okay? So that's pretty exciting, and that's why a lot of seniors use these as safety nets, because you just don't know what your future holds, okay? You don't know what type of care you'll need, what kind of medications you'll need, or maybe you're in good health and you just want to travel the world. So now, some people say, well, what happens if interest rates rise? Well, if you have a big line of credit, it actually could work in your favor because your line of credit will grow faster. Why? Because it's based on the interest rate plus the mortgage insurance, right? Simple. So let's take a look at a 6.5% example. Stress the word example, right? Well, again, the same 136 line of credit after 5 years is worth 186. And now after 10 years, when you're, say, 72, 73, 74, you have over $250,000 that's available to you. And remember, whatever you don't take grows. In this case, it's 6.5%. So you could take this number, multiply it by 6.5%, and know how much more money you'll have next year, or know how much you could just take off at 6.5%, and use that as your base. Right? I mean, that's a lot of money. You could just pull off 6.5% of that every year. It's a great safety net. And again, if you don't grasp this or you're struggling with it, watch the video again or call me. No cost to talk, okay? Couple final thoughts that I have. Number one, your line of credit and loan balance grow at the same interest rate. We talked about it a couple times. It's your rate plus your mortgage insurance. Lines of credit are a great way to protect your financial future. I think we've made our point on that. After 10 years, you may have $100,000, $200,000 tucked away. sitting there in your line of credit that you can access just in case you want or need it. Now, the line of credit growth is guaranteed regardless of market conditions. Let that sink in for a while. Even if your $300,000 house in our example were to go to $200,000, the line of credit growth will continue to go up. Okay? Last but not least, any borrowed funds are only payable when the home is sold. I know I've repeated that several times, but sometimes people really just don't get it. They always think they got to pay something. We already talked about what you have to pay. Okay? You have to pay your taxes and your insurance, HOA, the flood if you have it. Okay? Just that kind of stuff. Here is our legal disclaimer with our license numbers and all that good stuff. Feel free to stop the video here and read that through. And if you have questions, my phone number is on the website. Thanks so much for watching.